Quick disclaimer, these videos are meant for educational purposes only. Anything said or shown in any of these videos are personal opinion and my perspective. Trading carries a high level of risk, so anything done is your responsibility. Hey, how's it going, guys? Welcome back to mentfx, and I'm just getting ready for the upcoming week. We actually have the Sunday live webinar that we always have with our private group today in about an hour. So I wanted to make this last video for you guys as a finale to the series of videos I've released thus far on psychology and the 3-box methodology to show you the simplest and easiest way as a newbie or a beginner to experience or to start trading and testing the 3-box methodology and what exactly it is. So very quickly, before we even look at any examples, this is going to be very simple for anyone that's been following my channel for a while. What you're looking for are these two setups. You're either looking for an impulse in a direction, an area to trade from, and the confirmation of that area in the form of Wyckoff. Okay, so you're going to either have this, and this is going to exist when you're in a overall bullish market, right? This is going to represent an impulse. You're going to look for that confirmation of that impulse in this area here when it taps into that supply or demand zone, taking out and fulfilling other areas of inefficiency. And what are you going to do? You're going to look to target this high right here and allow positions and allow portions of positions to keep running, because oftentimes when liquidity gets taken or a structure is validated and continues in an order flow direction, it doesn't always make a pullback all the way down or doesn't always break new structure and go short. Sometimes it holds that structural point, that protected low holds, and it just continues going significantly higher for no reason. And as it does that, that's where you allow yourself to position yourself into very large moves. So that's going to be your approach from a bullish setup. This is going to be that bullish setup. And your bearish setup is a very, very simple one as well. You're going to have an impulse down in the form of a blue move down. You're going to have a red SND zone somewhere deciphered on that specific time frame that you're looking at, from which you can sell from. That's also going to usually have an imbalance. And then you're going to look for, as price comes into that, using the rule of 30 or any other rule where you go down a few time frames to look inside of here for that Wyckoff confirmation that's going to take you short. And this is going to be the case in a bearish market or a bearish impulse on whatever time frame you want. So this is going to look like this. It's going to look like a downtrend. It comes a break structure. You have an SND zone that's left behind with inefficiency. That inefficiency gets fulfilled in the form of some kind of Wyckoff, right? Taps in, Wyckoff, get in, and you're looking to do what? Target the low here as a form of liquidity. And then you're looking to target where? Significantly lower in the case that price wants to keep on running for no apparent reason. Now, again, it's not always going to do this. Sometimes it's going to come all the way back up and stop you out of break even. Sometimes it's going to come and break new structure to the top side and start going long. And sometimes it's going to come liquidate this high and then go short. That's part of trading, and that's going to happen. However, what you're going to want to do is you're going to want to allow portions of your positions to run, and that's where most of your money can be made. Even though this itself can be profitable and you can just target the first liquidity point and it can be profitable, you want to be able to allow your trades to run, because as smart money traders, we are footprint traders, which means we don't know which footprints are going to want to be traded back into or not going to be traded back into. And we also don't know which specific footprints in the form of prior left liquidity, such as liquidity that might exist all the way down here or liquidity here, is going to be taken first. You don't always know this. There's a good chance that you can ascertain which one's going to be taken based on a higher time frame approach, but more likely than not, you're not always going to know which side of liquidity is going to want to be attacked, and you don't know if the buy stop side or the sell stop side is going to want to be attacked next. So what you're going to do is you're going to allow your buys to potentially run to that high side liquidity, or your sells that might be created on that same time frame over time to then run to that downside liquidity, right? Sell side, buy side liquidity. And that's basically the overall premise of using the 3-box methodology. And your confirmation, this little green box right here, is oftentimes going to be under the rule of 30. Both of these are going to be looking at a time frame that you're looking for this setup on, divided by 30, right? And that time frame is going to be the time frame that you want to check. Now, again, if you want to take this to the next level and actually refine this specific approach and understand it from a variety of ways of entering, thinking about top-down analyzing, and understand different entry criteria that can confirm zones like this and keep you on different sides of the markets at all times and hedge properly, you can check out my mentorship available in the link below, right here on the screen, or even under the YouTube video in the description. Okay, and if you're actually ready and you've tested this system right here and you don't want to join the mentorship or anything like that, you don't have to. The community is amazing. It's vibrant. It's constantly active. So if you want to join, you can. But if you don't and you're already profitable and you're doing phenomenally for yourself, consider signing up with mentfunding. Link is at the top. And go for that one-step challenge. Take your time. Reduce your risk if you have to because of the 1 to 10 leverage and lower parameter set. And look to get funded with that account, especially if you're good. You can go for something like the 1 million. And I'd happily have you on this channel as you get funded with that 1 million account to talk about your journey, about your payouts, and how you were able to do what you did. Okay, so now that we have this setup laid out, let's go and look at a few examples so you understand how this is done. Okay, what we're gonna do is we are going to find a random pair that I don't even look at just for the sake of explanation for you guys. So we have UJ, GJ, and EU here. So we're going to look at something like NZD USD or AUD USD. I don't really care. We'll go with AUD USD. Okay, we have no markups on this. Perfect. So what we're going to do now is we're going to randomly replay to a random spot, and I'm going to show you potential setups that can present themselves, right? So what we're going to do is we're going to make this smaller. We're just gonna scroll to the left until I decide that it's good to go, right? So I'm just gonna kind of close my eyes and just scroll. Ready? You guys can see I'm not looking, so we're just gonna scroll. Hope it's scrolling. Yeah, it is. Okay, scroll, 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 scroll. Okay, we're gonna stop. So I don't know where we are. It doesn't really matter. Maybe I saw this beforehand. Maybe I have an eye at the back of my head. Maybe I got a screen over there that you guys can't see. Who knows? But we're just gonna go here and. There we go. And we are going to decide on a random time frame. So let's assume that we are someone that has a long-term job and we're people that do not want to be on the lower time frames. Let's assume that we are 4-hour traders. 4 hours, fine. Sure, we're on the 4 hour right now, so we'll look at the 4 hour. Or actually, to make it fair, I'll go to something new. So let's go to an 8 hour to make it just fair. And now we're going to decipher and see if there are opportunities that can be present themselves under the box of 3 methodology. So I'm going to do one backtest until a trade hits or loses. I don't really care. But just to show you how it works in terms of the way this setup is made to work, right? So what we have here is we have a break of structure to the downside. So what does that mean? That means we're in a bearish bias, which means we now have a blue POI. I mean, not a blue POI, a blue impulse that has now decided for us a high and a low. This is going to be a future target. This is going to be an invalidation point, which means where do we want to sell from? We want to be sellers from this supply zone right here, right? And potentially this supply zone right here. But because we don't want to make it too complex, we're going to just decide on this higher one and see if price wants to reach up for that. So let's see if it does. So this now rests as that blue impulse down, right? Because remember, there's no other structural play in here that needs to be used, right? So we're going to allow this to act as that area. So price reaches up into there. So we know we're mitigating it now. If this works on my first try, I swear I did not know this beforehand. I hope it fails. So those of you watching actually can see it in motion of how it can fail, but we are going to continue doing it the way we do it. So 8 hours, right? We're going to multiply that by 60. That makes it a minute. So that's 480-minute chart. We're going to divide it by 30, which is the rule of 30, and that's going to give you 16. So we should confirm this move here on a 15-minute chart, or a 16. In this case, 15 is fine, right? So we're going to go to a 15-minute chart and take a... Fuck, the date is not available that far back. Okay, well, we're going to go back to the 8 hour, and we're going to find where we were. Sadly, we're going to have to... Okay, so actually it didn't work. That's good. That's good to know. So you can see it didn't work here, but let's go ahead and just go to a 30-minute and see if there would have been a trade, 1, and if we would have been able to break even, 2, on this overall move. So let's go here. Let's go to a 30-minute. Maybe it'll be available. Okay, cool. It's available. So we have this zone deciphered, right? And again, as we're coming up to it, notice what we have. We have the transfer of weak to strong hands, right? Which means what? Well, it means that we have the start of a... Anakin, you okay? My dog's going crazy. Of a Wyckoff distribution, right? This is your Wyckoff distribution. Now, what does that mean? That means that the only way we really want to get involved is if this structural point right here gets displaced to the downside before we look to get involved on any sells. And instead of that occurring, we just kind of come right up and through it. So this point gets fully invalidated, which doesn't mean we're done looking for sells. It means that we still could be, because this point is the point of invalidation. So let's continue to look in the case that there is one. And I think this is a decent setup. So what ends up happening instead is that we have more weak to strong hand transfer, right? And that happens here, which means when we see our first displacement or impulse down in terms of structure, so this structural point gets taken out with displacement to the downside, we are valid to go for sells from where? The newly created supply zones, because now we have a fractal 3-box methodology prevalent, right? We have a blue POI, a red area to sell from, and we can reconfirm this, but we're not going to do that because we already have our higher time frame confirmation without invalidation, which means we are valid now to go short on this move right here. And as we're valid to do that, we can set this above this high or above this one, because remember, this is the protected high. So we'll leave it above there. And now we're going to watch it. It makes a low, comes up to mitigate, and then breaks this low. The second this low right here is broken, this trade goes to break even. So this trade ends up being break even now. So no matter what happens now, we are protected on this trade, even though it fails. And overall, our target still ends up down here, which overall is an RR of, here, let me go find that for you really quick. Overall, an RR of 1 to 18 if it runs, right? Which it doesn't. But again, you can already look for partials at where? You can look for partials at this liquidity here, at this liquidity here, and potentially this liquidity here. So because we already saw this met, let's actually look at this liquidity instead, just to be fair, because we know this one got hit, so kind of unfair for me to say let's take it there. So let's say our first partial will be here, and then our next partial will be down here, okay? And there we go, perfect. So price comes up to break even, and that's a non-trade, right? And this is going to happen when you're on these higher time frames, as I spoke about in the previous videos. You aren't always going to get setups that hit and then just run, right? In this case, it hit. It gave a lot of potential profit that you easily could have partialed at this low right here, right? Because this is in itself liquidity, right? Remember, any swing highs or swing lows, any swing highs and swing lows are going to be considered liquidity because they have buy stops above the swing highs and sell stops below the swing lows, which means if you target them, there's a good chance that if smart money needs to unload certain positions or reaccumulate or redistribute positions, it's going to be at these levels, which is why as smart money traders or as traders that enter on the footprints of smart money, we are also going to look to exit on the footprints of smart money or the footprints of retail left behind liquidity, which is always in the form of multiple traders, right? Retail liquidity isn't just, that one person that trades channels. It's also banks, it's also hedge funds, it's also countries, it's also governments operating on higher time frames. They're not looking at candlesticks, but they're operating on psychological levels as well, and that is shown to us in the chart. So there's a few things working in tandem to create this understanding. So that's an 8-hour example, and in this case it was a loss. Well, actually it was not a loss, it was a break even. So we're going to stop right there. That's a break even on the 8-hour. Now, what we're going to do is we're going to exit this. We're going to go to a new pair. So in this case, let's just go NZD USD because I said I would look at that. We're going to do it on a 4-hour this time. I don't know what these zones were. On a 4-hour this time to show an example of something where you can use a lower time frame, right? If you're someone that doesn't want to be all the way up on the 8 hours or the dailies. So again, we're going to shrink this down just like that. We're going to turn around. We're going to click like 5 times and see where we are. Righty? So 1, 2, 3, 4, 5. Let's go 6, 7, whatever. That's good. Hopefully it moved. So we're going to go replay, and I'm going to pick a random spot. So here we go, and right there. Okay, we got it. Cool. So here we go. Right, let's look at where we are right now with immediate price and see if there's an opportunity that we can potentially look to get involved on using the 3-box methodology. Well, clearly, we have some kind of break of structure that occurred here. Right? And again, we have an impulse that caused that break, which was this entire one right here. We have this impulse down. We have S&D zones that created that, right? We have this one right here, and we have this one right here. Now, sadly, those already played, so our next target should be this low. So let's wait for a target to be met or an invalidation to be hit, and then we'll look for an entry or a new setup. So let's wait. Okay, great. So we have this hit. So first of all, this trade would have been phenomenal. 3-box setup, perfectly set up, right? There's going to be a green box in here that you would have been able to trade down. That's perfect. Now we have a newly prescribed same thing happening, right? We have an impulse down in the form of our blue box, our box number 1. We have an S&D zone as a box number 2. Right, and now we're going to look for it to mitigate and go and confirm it. So let's see if we get up there. Nope, so, oh wait, maybe. So there's no displacement yet to the downside, so we're going to keep this area on. Okay, so we just displaced down. So again, this gets canceled and there's nothing to do. This is a great example of showing you that if you're on a higher time frame, there's going to be times where you're just waiting and doing nothing because not always are you going to get the best pullbacks. Now, on a lower time frame, I'm sure there's an entry in here, right? You can see this breakdown, this retrace to this beautiful zone, and a continuation, right? On a 1-hour or 2-hour, if you're someone that was on a 2-hour chart, actually, there's a perfect example here, right? You have impulse 1, right? So you have blue box 1, red box 2, 3, and box 3 for confirmation. And inside of here, 2-hour chart, what does that mean? You should be on like a 30-minute chart or something, 15, 30-minute. You'll see the Wyckoff, right? Wyckoff, probably 50-minute is better. Here you go, right? Wyckoff, displacement down, test, continuation. So we're gonna allow that to act as that example because I wanna keep this video relatively short, right? Last up move is around here. So that would have been your overall entry. Maybe you would have gotten hit, maybe you wouldn't have. Protected above the high. Overall target where? This low here as your first target, and then your second target where? Exactly. Zoom out, right? So now you'd go to a higher time frame and you'd say, okay, where am I in price? So even though this would have been your first target right here as a partial, right there, you'd also be now looking at probably these equal lows, right, as a next target. And then you could go left a little bit more and you could say something like, this inefficiency could be my next target, right? So maybe these equal lows right here. So there you go. You have a few lows to target. Overall can be targeted here. And now we can just take a look at how that delivers and if it does deliver, right? Okay, so that delivers to that partial. You take another partial there. Next partial you're looking at is here, right? We can see if that delivers, right? And you'd be just at break even, no difference. Okay, so you just be waiting, right? And remember, the reason we don't trail is because we don't know what liquidity is going to be attacked before a new liquidity is attacked, right? Just because we made this structural point or this one doesn't mean it's going to hold. So we allow ourselves to lock in here and allow for moves like this to take place so that when they take place and continue, if they do continue, they can deliver to us more profit. Now, again, we can hit to a higher time frame in case it wants to come all the way here, which is that interliquidity, and we can now target an even higher overall liquidity of this point here, right? We have more lows here. So we're kind of looking at support resistance levels as liquidity targets because we know that's where liquidity resides because that's where retail eyes, large order eyes, large institutional bank order eyes, retail bank eyes are located. So we know liquidity might be delivered to that point. So let's see if it delivers. Let's take a look. So it just plays around this area. Maybe it comes back up to break even. Let's see. Okay, nope. So it delivers to the next partial perfectly. So you have partial 1 met, partial 2 met, partial 3 met. Now you're looking at this partial 4, still locked in at break even. And we get hit break even, right? That's a good example of a 2-hour setup, for instance. I know I wasn't able to show you a 4-hour, but that happens. Now we're going to look at a lower time frame. 2 lower time frames, and now we're going to be done for the 3-box methodology on this specific video. So now we'll do, let's say, a 30-minute with a 1-minute confirmation. And we're going to make this tiny again, and we're going to go to a different random pair. Let's go GBP cat, something random again. Okay, great. Let's make this small. Cool. Let's turn around. 1, 2, 3, 4, whatever. It doesn't even matter. Here we go. Good enough. And random. There we go. So we're going to look at this and see where we are in overall price. Clearly, we are in a bearish bias, and that bearish bias is continuing to deliver. And clearly, our most recent break was this one right here, right? Which means clearly we have a blue POI here, right? Which means what? We want to be a seller if and when price comes to hit this S&D zone right here, right? The last up move before the down move. Now, again, if you want to get deeper on this understanding in itself, check out my mentorship. So we're going to look for what? For mitigation here. Let's see if we get there. Do we get mitigation? Do we get mitigation? Nope, we don't get mitigation. Instead, we break again. So this is canceled. We have a new break of structure down to the downside right here. Right here. Right now we have a new blue POI down right here. Right, notice how we follow intermediary trend. We don't follow everything else. We're not pajama stripe traders. We're not going, here's my S&D, here's my S&D, here's my S&D, here's my S&D. We don't care about them. These are no longer relevant areas for our specific time frame, our specific rules, and our specific 3-box methodology that we used to get involved. We don't need to follow every single zone. We are not stripe pajama players. We aren't sitting here going, here's my zone, you know, here's another zone that it might stop at. Here's an overall zone of support resistance. Here's another zone right here, right? This is how some even smart money traders teach you. They teach you to look at all these zones and go, all right, wait for mitigation, wait for mitigation. And what is this going to create? It's going to create a ton of confusion. You want to eliminate all confusion. And to do that, you look at the most intermediary and understood trend, or you zoom out and look at the larger trend to establish areas that you can trade from. But right now, the most important one, if you're a 30-minute trader or someone that wants to be on a lower time frame, this is the most important area, right? So in this case, you have this red POI right here, just like that. It looks like it mitigated here. I'm going to go back 1 candle so we can watch it mitigate, so we can see if there's any confirmation, right? Rule of 30, 1 minute. Fuck, we don't have historical data there. Okay, so we're gonna have to go to a little bit of a lower time frame. Sorry that we have to do this again. We can go ahead and find where that was, hopefully. I have no idea where that was. Damn, that sucks. Did I lose it? I think I may have lost it, guys. Maybe we can go like this and find out where it was. No chance. No chance at all. Oh, there it is. Okay, nice. We found it. So it's right here. There we go. Okay, well, you can actually see that in this case, it would be a fail, right? But now we need to ask ourselves, was there an actual entry that presented itself before we failed? So maybe we can go to a 5-minute and take a look. Okay, great. So perfect example where we have some form of weak to strong hand transfer, but zero displacement of any sort to the downside, right? No displacement here, no breaks down, just small wicks that end up coming, and taking it all out. So then we have new weak to strong hand transfers, and guess what? We have no displacement to the downside of any sort. So again, the 3-box methodology, you need the prevalence and the existence of all 3 things if you want to look for an entry. You can't just have blue and red and then enter, because that's not how we look for confirmation, and that's not how we confirm the footprints that have been left behind. So nothing there. Let's continue, right? So I'm going to go back to the 30-minute, and because I went too far ahead, I'm just going to go back to an area that makes sense. So we're just going to go back here because we know a 1-minute might be available here. I actually did not look at price, but you know, either way, I don't really care if you believe me or not. So most recently here, we clearly can see there's a break of structure to the downside, and that break of structure comes from this impulse right here, right? Which means our red POI would be this one right here, okay? So now we want to see price on the 1-minute, in this case, displace to the downside so we can take sells on it. Let's see if we have that. So in this case, what we have is, again, we have the relationship of weak to strong hand transfer. And on top of that, we do have the displacement, the move right down below most important structural zones to the downside. And that displacement comes from where? The POI is established, the last up moves before the down moves of that, and we protect ourselves at the high. And where are our overall targets? The overall, in this case, this would be a blue POI, I'm sorry, blue POI. And we have all 3 things, once again, in correlation. So your overall targets would be here. Now, what does that mean? Does that mean we just need to target those? No. Because we get refined entries, your overall targets can exist where? Well, because we got this refined entry, you can look at this and ask yourself, where are the lows? Clearly, there are lows here. This could be your first target, right? Your second target could be these equal lows right here. Ton of liquidity here, right? A lot of interest is going to be here, so we're going to probably run that in the future. You could then look to the left and say liquidity here and liquidity here. So because these are so close, we can delete this one, and this could be your overall trade. Now, looking at this, let's allow this to play out now. Actually, so let's follow along with the mitigation too so we can know when we would break even. So price mitigates and breaks down. At this point, we wouldn't be break even yet because price can easily come back up, test, and then keep going short. Instead, price comes up, goes short, mitigates, and goes short. At that point, this is a break-even trade. We can move to break-even and maybe a little bit deeper just to allow for commissions. But overall, we're at break-even, right? Your first partial in this area would be met if you were trading these partials. On the other hand, if you're someone like me and want to go for your higher RR plays, you might be stopped out at break-even on this trade. Let's take a look. Okay, let's go to a higher time frame. So nothing yet. You'd still just be sitting here at break-even. Okay, so actually you'd have your next partial met at those equal lows right there. So again, 2 partials met based on type of trader you are, right? And overall targeting this right here. But what does that also mean? Your higher targets as you get here are going to exist in much deeper and more inefficient areas, right? So let's see if we get to that next area. Nothing yet. Do we just come up to break even? Let's see. Let's expand this. Great. And that then goes to break even after meeting multiple entries and multiple points of partials, right? This is why partials, taking profits, are so vital, especially when it comes to an understanding that is grounded in smart money, right? You need to understand that with smart money, and I've said this in previous videos, you don't always know which direction price is going to go in. What you can do, though, is predict using the 3-box methodology how price is going to deliver, and if that prediction delivers as per your rules and your confirmation, that's when you look to get involved and begin to manage your trades throughout the entire life cycle of that trade. On the other hand, if rules never get delivered, as we saw in some of the other time frames, you stay out of the trade. And if they do deliver, you can look to get involved with the proper management in place, because that proper management is going to make or break you as a trader. If you're able to go and watch that structure unfold on whatever time frame and look to get involved correctly and look to manage that and break even the right time, allow your trades to come back to break even if they have to, allow yourself and your partials to be hit instead of just close your trades, right? This is a very psychological element. Remember, just because when you start, you might experience some of this or even some of this because you might be taking commission losses like that, right? Or maybe even some of this because you're taking some losses and tiny wins and this, right? That doesn't mean you're an unprofitable trader. What makes you unprofitable is the next time a win hits and a good win hits, instead of allowing that win to go and run to, let's say, this equity level, you end up allowing that win to run to here because you're scared of being under. Or even you let it just run up to break even and you close. and you don't allow it to potentially do the move that it's looking for, right? What does this potential do the move that we're looking for mean? It means, let's say this trade right here runs to this partial and you close out fully without understanding that, you know, your lower liquidity didn't get met and you could potentially go even deeper. Because why? The market is fractal, which means it constantly has multiple liquidity points it's aiming for, and it constantly has new order flow and new structure that it creates that it may or may not move to or pull back to. And in the case that there's a higher time frame displacement and you get involved, let's say, on this inside structure right here, and you get involved, it doesn't have to get here. It can. And you might take this, catch it to this partial, and then get broken even on it, and then it comes here, and then you get a short. Or it could just hit this, take that, maybe make a tiny little retracement, and boom, start running all the liquidity here and all the liquidity here, and just keep running. And those moves are going to create this kind of equity curve and profitability over time. Now, again, it doesn't matter if you're a higher R or a lower R trader. At the foundation, at the bottom line of everything, you should have an overall system that you've tested, back tested, have a journal of, and have constantly seen how it works and interacts with yourself, the times you trade, and your personality versus like based on the time frames you look at and the currency pairs you look at, right? This was a great example, and I wanted to make this video for you guys to show you that one, doesn't matter what we look at. It could be any pair on any time frame. The setup is going to be the same, and it's going to repeat on repeat on repeat on repeat. It's your job to allow those setups to occur. One, to run without you if they want to run without you. Two, to not make the mitigation if it doesn't want to make it. Three, and just keep going. 4, to fail to give you the mitigation and keep going. 5, to get you into trades, but then take you out of break even. 6, to get you in the trades, get you at small partials, and then take you out. Or 7, or 8, whatever number we're on, get you into that trade, allow you to partial, and then just keep fucking running. And you can secure all the way through. And again, I don't care whether you do this with mentfunding, I don't care if you do this with another firm, and I don't care if you do this on a personal account. But what I do care about is that you've taken the time on demo, on your journal, to understand how your system works. Because at the end of the day, the best psychological approach to trading is one that gives you the best confidence and understanding of an overall system. And that confidence and understanding of an overall system only comes from the execution and understanding of rules that you follow every single time you take a trade, whether it's on a $100 account, a $100,000 account, a mentfunding $1 million account, or a personal multi-million-dollar account. It really doesn't matter. But what matters is the approach that you use towards your trading and how you treat yourself as a trader. Are you looking for this long term, or are you looking for that short squeeze and trying to get that short amount of profit and run with it? Because if you are, most of the time, you'll be the kind of trader that either ends up in this area right here, constantly battling between break-even and losses, break-even, right? Losses, break-even, losses, break-even, losses, and then it just continues, right? And it takes you out. On the other hand, if you're the other type of trader that allows yourself to take losses, but allows those wins to run when they occur and when they don't run without you, and when they give you the mitigation you're looking for, or when it corresponds to your rules, that's where you have these larger runs. That is how algorithmic traders, or people that have algorithms, end up making money too. They code systems that they know work, and they allow those systems to run, right? I think it's great that there's so many ways to trade this market, and there's a billion ways that you can learn, right? And there's many people you can learn from. There's algorithmic ways, there's smart money ways. There's also even one of the ways that I trade now, or have traded but have only put into practice recently and have done it on my live account. You can be trading Elliot Wave too. As long as you have an approach that you understand can make you money, especially with how you allow trades to run and how you allow your stop losses to get hit, drawdowns to be hit, or how you limit your losses, aka how you move that stop loss in accordance to your actual plan and structure and rules, that is going to determine whether or not you're going to be profitable over the long haul. Now, again, this is not financial advice, none of that funny business, right? This is just an approach to the market that I've seen that works, and it's all perspective based. All you have to do as a trader is either 1, join a mentorship and keep learning, or 2, go and test this yourself and constantly make mini quirks and mini changes that you begin to see and spot on repeat, and create that into a rule-based methodology and a system for yourself. So once again, thank you so much for watching, guys. This was a deep look into how you can apply the 3-box methodology in a very simple, coherent, and understandable way across any time frame and any pair, including crypto, indices, commodities, and anything else that you want to be a trader on, and stocks, all that fun stuff, right? All it takes from you is to go to the chart instead of the reply and comment section and test it. Now, once you've tested it, come back to here, come back to the channel, like, subscribe, do the fun shit that you like to do, and leave a comment. I love reading through the comments. I love interacting with you guys, and I love getting responses and ideas thrown out by some of you. So thank you again very much for watching, and I'll see you guys in the next video.